President Trump, you can make America's economy great again. Here's how. Invest, Mr. President, not only in infrastructure, but in the industries and technologies of the future. You've been elected president at a unique moment in history that gives the government of the United States the ability to borrow and invest in the U.S. economy on a scale not only large enough to rebuild America's infrastructure, but large enough to also induce a new technological revolution that would restructure the entire economy and make it great again, greater than ever. If you grasp this opportunity, the United States will have unassailable supremacy in the industries of the future. You'll lock in another American century, and you will vastly improve the well-being of every American and the well-being of every person on this planet. However, you've also been elected at a time when the global economy is in grave danger of collapsing into a new depression, one from which it might not recover for decades, if ever. One misstep on your part, and instead of making the economy great again, you'll make the Great Depression again. Here's what you need to know and to act on to succeed. The global economy is an enormous economic bubble that has been inflated by credit. If the credit contracts, the bubble will pop and the new Great Depression will begin. If interest rates go up significantly, the bubble will pop and the new Great Depression will begin. One wrong move on your part and the economy will spiral out of control into a depression. It won't be a short and sharp depression like 1921. It will be long and devastating like 1929 to 1945. That's the bad news. Here's the good news. You are absolutely right to call for government investment in infrastructure. But don't stop there. During your administration, the government can borrow and invest trillions of dollars in the U.S. economy without causing inflation. The combination of globalization and fiat money makes this possible. Possible for the first time ever. You not only have the opportunity to rebuild American infrastructure so that it's second to none, as you promised to do in your victory speech, you also have the opportunity to invest in 21st century industries and technologies on a scale that's too big to fail, thereby guaranteeing that the United States remains the most prosperous and powerful country in the world for many decades to come. The government investment in infrastructure will create jobs and generate strong economic growth in the short to medium term. The government investment in the industries of the future will mean great jobs and strong economic growth for Americans for the rest of this century. In the past, the government couldn't run large budget deficits without causing high rates of destabilizing inflation. Today, the United States government can borrow and invest many trillions of dollars at little to no cost, and do so without causing inflation. In this presentation, I'll explain why. I'll also describe the kind of government investment that's required to pull the U.S. and the world out of this economic crisis, and the extraordinary benefits that such investments would produce. The last 8 years have demonstrated that the U.S. government can borrow and spend trillions of dollars and finance much of that new debt with fiat money creation without causing inflation. This has never been possible before. In the past, such a large increase in government spending, financed with huge amounts of money creation, would have quickly led to hyperinflation, but not now. When Presidents Johnson, Nixon, Ford, and Carter ran large budget deficits, those deficits overstimulated the U.S. economy and led to high rates of inflation. That's what you can see in this chart. The U.S. government budget deficits from 1950 up until 1980. Under the Johnson administration, the Vietnam War and the Great Society programs caused larger budget deficits than had been typical in the past. And then Nixon and Ford, and then Carter. Those unusually large budget deficits overstimulated the US economy. Inflation surged when the economy reached full employment and full capacity utilization. That's what you can see in this chart, consumer price inflation up to 1980. It peaked at 14.6% in 1980 because of this overstimulation through the budget deficits. Then Ronald Reagan became president in 1981, and his government ran budget deficits that were a great deal larger than the ones in the 1960s and 70s. They were the largest peacetime budget deficits in US history up until then. During his first 5 years in office, they averaged 5% of GDP. So you can see the Reagan years, 81, 82, 83, 84, 85. This was 5% of GDP a year, much larger than the budget deficits that came before. But inflation fell sharply from 1981 onwards. So what had changed? Well, Fed Chairman Volcker crushed inflation with very high rates of interest in 1981. But the massive Reagan budget deficits should have reignited inflation. Why didn't they? They didn't because the US started running very large trade deficits with the rest of the world for the first time ever. Those deficits allowed the US to circumvent the domestic bottlenecks of full employment and limited industrial capacity. The United States could now acquire whatever it wanted in the global economy, where the supply of low-cost labor was nearly limitless. So that's what you can see in this chart. It shows the current account balance. Up until the breakdown of Bretton Woods, trade had to balance. Afterwards, the US started running big budget deficits during the Reagan years for the first time ever. Very large budget deficits. Very large trade deficits. And the US has had very large trade deficits ever since. These trade deficits fundamentally change the way the economy works. So here you can see the current account deficit up until last year. During the Reagan years, it peaked at 3% of US GDP. That was considered incredibly large. But by 2006, these had blown out to 6% of US GDP, $800 billion that year alone. After 1980, the US continued to buy more and more goods from low-wage countries, and that caused inflation to continue to fall. Globalization is very deflationary. So that's what you can see in this chart. The CPI, the consumer price inflation, has been falling and falling and falling ever since the United States started running large trade deficits with the rest of the world. The deflationary forces of globalization, and more recently, quantitative easing by the Fed, the Bank of Japan, the European Central Bank, and the Bank of England, have driven US government bond yields to record low levels. That's what you see here, the 10-year US government bond yield. And that has pushed mortgage rates to record low levels. So it's globalization that explains why inflation has been so low. Before globalization, each country had a relatively closed economy. Those economies experienced inflation when the domestic labor force and the domestic production facilities were fully utilized. Now we have a global economy with a labor force numbering in the billions and production facilities that stretch around the world. That means that domestic bottlenecks are now irrelevant. Consequently, inflation is no longer ignited by domestic constraints. And the global economy is very far from hitting full capacity. 2 billion people live on less than $3 a day. Globally, we won't hit labor constraints for decades, perhaps not for generations. Meanwhile, seemingly limitless credit growth in China has produced excess capacity there across all industries on a mind-boggling scale. Full capacity utilization there certainly won't be reached during your administration. This means we can use a combination of fiscal and monetary stimulus on a much greater scale than ever attempted before and generate much higher rates of economic growth than we have now, all without causing a significant pickup in inflation. And there's another reason interest rates have fallen since the early 1980s, and it too is related to the US current account deficit. It's the balance of payments. Every country's balance of payments must balance. The United States' very large current account deficits must be financed by equally large capital inflows from abroad. So here you can see the US balance of payments. The black line is the US current account deficit, which we've been looking at. And the orange line is the US surplus on the capital and financial account. In other words, the foreign capital inflows that must come into the country to finance the current account deficit. These exactly offset each other. That means the larger the US current account deficits became, the more foreign money came into the United States to finance them. And much of that foreign capital inflow went into US government bonds. That made it much easier to finance the US government's budget deficits at very low interest rates. So the large US trade deficits drove down interest rates in two ways. Importing cheap goods made with low-cost labor pushed down inflation. And two, the foreign capital that entered the country to finance the current account deficits was invested in US government bonds, pushing up the price of those bonds and pushing down their yields. And low inflation made quantitative easing possible. When the economic crisis began in 2008, the Fed was able to print money and reflate the economy because there was no inflation. And quantitative easing kept the United States and the world from collapsing into a new Great Depression. Here you can see the Fed's total assets. The Fed created $3.6 trillion since the crisis began. And quantitative easing drove up the stock market. Every time there was a round of quantitative easing, the stock market went up. It also reflated home prices. That's what you can see in this chart. So because the Fed bought $3.6 trillion of financial assets with new money, household net worth rose by $33 trillion, or by 61%, between the post-crisis low in the first quarter of 2009 and now, $33 trillion of new wealth. That had an enormously positive impact on the US economy and the global economy. But the game's over if interest rates rise significantly. Credit would contract as it would become less affordable, and asset prices would fall for the same reasons that asset prices rose while interest rates were falling. Credit contraction and falling asset prices would most probably plunge the United States economy into a severe depression, and that would cause the global economy and financial system to collapse, as they did during the 1930s. As interest rates fell, credit became more affordable. So credit expanded and credit growth drove economic growth. So in this chart you can see interest rates, the federal funds rates. They fell to zero. And the green line shows the ratio of total credit to GDP. It rose from 150% in 1980 up to 370%. So as interest rates fell, credit became more affordable and credit growth expanded and it drove economic growth. But now if interest rates rise, credit will contract and the economy will crash. And this chart shows household net worth as a percent of disposable personal income. You can think of this as a ratio of wealth to income. So notice that this ratio of wealth to income is near record levels, record high levels, because very low interest rates and quantitative easing have pushed up asset prices. So the ratio of wealth to income. Look at the time of the NASDAQ bubble, this went up to about 600%, and then it crashed. The average, going back to 1950, has been around 525, 550%. Well, at the time of the property bubble in 2006 and 7, this peaked at 650%, and then it crashed. Now it's back to 640%. So if interest rates rise now, then asset prices are going to crash. What this means is that you must not allow interest rates to rise. Therefore, you cannot impose trade tariffs, and you should not cut taxes. Trade tariffs would push up interest rates because first, they would push up the cost of imported goods, causing inflation to rise. And second, they would also reduce the current account deficit, and that would reduce the financial account surplus, and so reduce the foreign demand for US government bonds. With less demand, prices would fall and interest rates would rise. Don't cut taxes. Don't do it. If you cut taxes, the budget deficit will increase, so the government will have to borrow more. As long as interest rates remain low, the government will be able to borrow an enormous amount of money and even finance part of it with quantitative easing. But there are limits to everything. Do you want to cut taxes for the wealthy, or do you want to make America's economy great again? You probably can't do both. Tax cuts could destroy your chance to restructure the US economy, and they won't help the economy in the long run. If you cut corporate taxes, corporations still won't invest in the United States unless you stop them from building their factories in low-wage countries. They already have a great deal of excess cash. That's why they keep buying back their stocks instead of investing in America. If you cut income taxes for the wealthy, they won't spend more, so that won't help the economy, but it will increase income inequality. If you cut income taxes for the middle class and the poor, they will spend the extra cash, but they'll spend it on consumer goods made in China. So that will help China's economy, but it won't help the US economy. One of your economic advisors was quoted as saying that the tax cuts were necessary to help small and medium-sized businesses. If that's true, and you really feel that's important, then only cut taxes for those businesses with revenues of less than $15 million a year, not for the large corporations. And pay for those tax cuts by increasing the tax rate on the personal incomes greater than $5 million a year. Don't run up the budget deficit and the national debt to pay for tax cuts for corporations and the wealthy. Every dollar the government wastes on tax cuts could be used to restructure the US economy through government investment in new industries and technologies, investments that would make America's economy great again. You have to choose. Do you want trillions of dollars of tax cuts, or do you want to make the US the world's undisputed technological superpower for the rest of this century? Tax cuts or a cure for cancer? Tax cuts are free, limitless, clean energy. Tax cuts will drive up US government debt and only boost China's growing power. Government investment in 21st century industries and technologies in the United States will lock in another American century. Your transition team has indicated that you will use public-private partnerships to rebuild America's infrastructure. You can also use public-private partnerships to invest trillions of dollars into research and development in 21st century industries and technologies. You're a businessman. Businessmen invest. During your administration, the government can invest with the private sector by setting up joint venture companies, public-private joint ventures. The government's role would be to provide the capital, in effect, making it the largest venture capital firm in history. The entrepreneurs would manage the companies. You select the 10,000 most promising American entrepreneurs, set up joint venture companies with them, have the government fund these companies lavishly in exchange for a 60% government equity stake, and watch the miracles spring out of these investments. Sure, there will be some losses, but they would be completely irrelevant when weighed against the successes. Over the next 8 years, the government could invest $1 trillion each in nanotech, biotech, genetic engineering, and green energies, along with a few others. It would be like NASA, but on a much larger scale, and managed by the private sector. In addition to generating an extraordinary economic boom, these investments would produce technological miracles and medical marvels, and before long, limitless and nearly free, non-polluting energy. Just imagine if the US government had invested $3 trillion in new industries and technologies instead of spending $3 trillion invading Iraq 15 years ago. The 2009 stimulus package was about $800 billion. It could have been very much larger. Just imagine if it had also included a plan to invest an extra $3 trillion over 10 years into genetic research, biotech, nanotech, etc. The economy would have grown faster. Structurally, it would now be much more sound. The government debt and interest rates would not be noticeably higher, and we might possibly have a cancer cure or other medical and technological marvels. We still have the opportunity to make those kinds of investments over the next 10 years. Military spending isn't the only way to prevent a depression. We need and must have new government investment in infrastructure, but infrastructure investments will only generate profits for our society indirectly through job creation and greater efficiency. Government investments in new industries and technologies would generate profits directly, enormous profits. For instance, when one of the companies set up as a public-private joint venture discovers a cure for cancer, it could be listed on NASDAQ for $10 trillion, paying for itself many times over, with the government, that is the American public, keeping 60% of the profits from the government's equity stake. The profits generated from these kinds of investments would be so huge that they would soon pay off the entire national debt. The world is in the midst of the greatest technological acceleration in history. You have the opportunity to pull the United States and the world out of economic crisis by funding this revolution. Do you want to solve the long-term Social Security and Medicare crisis? Then cure all the diseases and reverse aging. The mission statement of Calico, one of Google's subsidiaries, is to cure death. All this sounds like science fiction now, just like Jules Verne's flying machines and submarines did not that long ago. But these are the kinds of things our country could achieve if you grasp the opportunities that this unique moment in history presents. Furthermore, this public-private joint venture approach will ensure that the people who voted for you will share in the benefits that this technological revolution will create. Better infrastructure alone is not going to make America's economy great again, Mr. President. When the economic crisis began in 2008, the government's budget deficit blew out to $1.4 trillion, 10% of GDP, mostly because government revenues collapsed. Between 2008 and now, government debt has increased by $9 trillion. The Fed financed $3.6 trillion of that increase in debt by printing money from thin air. Quantitative easing made it possible to finance so much debt at very low interest rates. It also reflated the US economy so that it once again began generating large tax revenues that brought the budget deficit back down to just 2.7% last year. If you keep inflation low, you can use quantitative easing to finance investments that will restructure the US economy and make it great again. The ability to use quantitative easing without causing inflation is the thing that makes this a unique moment in history. Quantitative easing can be your most effective tool as long as there's no inflation. You need to understand that for all intents and purposes, quantitative easing effectively cancels government debt. So far, the Fed has canceled 13% of all US government debt by printing money and buying government bonds. So long as the Fed never sells the bonds it has bought through quantitative easing, and so long as it rolls them over when they mature, as it does now, then quantitative easing is effectively debt cancellation. The Treasury pays interest on those bonds to the Fed, but at the end of every year, the Fed gives almost all of its interest income, all of its profits, back to the Treasury. In 2014, the Fed gave the Treasury almost $100 billion, which reduced the budget deficit by 20%. Since QE began, the Fed has given the Treasury more than $500 billion. Debt that does not pay interest is not really debt. You like debt? This is the kind of debt that you should love. More quantitative easing equals less government debt. So the more QE, the better. The stars are aligned. You instinctively understand the desperate need to invest in American infrastructure, even if that means increasing the national debt. And you have the political clout to make sure that Congress funds this investment, something it was unwilling to do until now. At the same time, the combination of globalization and fiat money makes it possible for the US government to borrow and invest trillions of dollars at little or even no cost whatsoever. Now that you've shattered the taboos of fiscal stimulus and increasing level of national debt, all that remains to do is to determine what kind of investments will generate the greatest benefits, and then to make those investments. Do you want to go down in history as one of America's greatest presidents? Then announce a cancer moonshot in your inaugural address. Tell the world that the United States will cure cancer by 2030, just as JFK announced in 1961 that the United States would send a man to the moon by 1970. I strongly recommend that you watch Kennedy's moonshot speech. When you do, I'm sure you'll agree that on that day, America was very great indeed. Here's the link. Don't give the corporations and the wealthiest 1% tax cuts. Give them revenues and profits. Profits generated from public-private joint ventures. They'll make much more money that way, and they'll make it for much longer. Very large-scale government investment in the industries and technologies of the future will lift the poor out of poverty. It will save the middle class, and it will make the richest segments of our society wealthy and healthy beyond their wildest dreams. This is a once-in-history opportunity, Mr. President. Grasp it. Invest. and make America's economy greater than ever.